the petrodollar is dying again. That sentence keeps going viral like a zombie headline because it sounds like the kind of world-changing secret you should have learned in school, but somehow never did. And if you've heard it enough times, you start to feel a weird kind of anger. You worked, you saved, you held dollars. You built your plans around a system that everyone told you was stable. And now the internet is telling you there was a secret deal behind that stability. And that deal just ended. And the dollar is about to collapse. And you missed the memo. Here is the uncomfortable truth. There was never a single secret petrodollar treaty that held the world together like a magic contract. There was a set of incentives, pipes, protections, and habits that made the dollar the default language of oil. And the reason you never saw a single smoking gun document is because the petrodollar was never one piece of paper. It was a machine, and if you want to know whether the machine is weakening, you have to stop hunting for the myth and start watching the parts that actually move. Because right now, the most dangerous mistake is not being bullish or bearish on the dollar. The most dangerous mistake is thinking the system is a story, it is plumbing. And plumbing does not break the way stories do. It leaks first, quietly, in places most people never look. If you stay with me, you will get the leak map. You would know what would actually have to change for the dollar to lose oil dominance in a meaningful way. And you will know what to watch so you do not get whiplashed by every new headline. And you are going to get something practical too. Not a fantasy prediction. A way to position your thinking around real-world incentives, which companies benefit when the dollar remains the default. Which companies gain when settlement fragments, and what a smart person does when the world moves from one clear highway into a mess of smaller roads. Quick note before we go further, because it matters. This is educational commentary. It is not a recommendation for you to buy or sell anything. Now, let me start with the mystery that should have been front page news every time it happened. Oil trades happen in currencies that were not dollars, and the world did not end. No sirens, no emergency broadcast, no instant dollar collapse. So why do people keep acting like the first non-dollar oil trade is a death sentence? Because most people misunderstand what the petrodollar is. They think petrodollar means every barrel must be paid in dollars by law. That is not how it works. The petrodollar is not a law. It is not a treaty that can expire like a subscription. It is a network effect. It is the same reason pilots speak English even when they are not from English-speaking countries. It is the same reason the world uses a dominant operating system even when other systems exist. It is the same reason the biggest airport hubs keep getting bigger. It is the same reason the deepest pool stays the easiest place to swim, even if you could technically swim somewhere else. The dollar became the default oil language because the dollar system offered the deepest liquidity, the easiest hedging, the most trusted settlement infrastructure, and the strongest security alignment for key producers across a long arc of history. It was not a secret handshake. It was a stack of advantages. And here is where the myth becomes addictive. A treaty story makes people feel like they found the hidden switch. If you can find the switch, you can predict the collapse. If you can predict the collapse, you can feel early. If you can feel early, you can feel safe. But the real system does not have a single switch. It has interlocking gears. So let us build the gears, because once you see them, you will stop being emotionally manipulated by petrodollar doom videos. Start with the most basic question. When an oil exporter sells oil, what do they actually want? They want revenue that can be spent globally, parked safely, hedged easily, and moved through banks without friction. They want a currency that behaves like water in a desert, accepted everywhere. Easy to store, easy to use, easy to protect. That currency has been the dollar for a long time. Not because the world is in love with America, but because the dollar system is the biggest pool of financial infrastructure on earth. Now imagine you are a producer. You can invoice oil in any currency you want, but invoicing is only the surface. The real world cost is everything that happens after. How do you hedge price risk? How do you hedge currency risk? How do you invest the proceeds? How do you finance projects? How do you pay suppliers? How do you pay for ships, insurance, machinery, and the global supply chain that supports the energy complex? Here is the part everyone skips. And this is where the petrodollar myth collapses into a more interesting truth. Oil pricing is tied to a whole ecosystem of dollar-based hedging and dollar-based finance. It is not just that buyers pay in dollars. It is that the most liquid futures markets, the deepest derivatives, the most widely used benchmarks, the biggest clearing systems, the largest repo and treasury collateral pool in the global banking relationships are all built around the dollar as a center of gravity. You can price a barrel in another currency. But if you still hedge in dollars, finance ships in dollars, insure cargo in dollars, and park surpluses in dollar assets, you did not escape the system. You changed the label on the receipt. So when someone tells you the petrodollar is dead because oil was sold in some other currency, ask the question that matters. Did the ecosystem change, or did the invoice change? Because the invoice can change without dethroning the ecosystem. Now this is where you get your first ledger beat. You saved the drama of a single treaty story, but you paid for it with confusion. You saved a clean villain narrative, but you paid for it with the inability to tell a real shift from a symbolic headline. And if you trade your worldview on symbolism, you get shaken out by noise. Now, let me bring you into the real origin story in a way that makes sense. After the major oil shocks, the world needed stability. The United States wanted energy priced in dollars and wanted a stable flow through global markets. Key producers wanted security guarantees, stable trade relationships, and a place to recycle surplus revenue. Banks wanted a consistent settlement language. Traders wanted liquid markets. Everyone wanted the biggest pool. So the dollar became the common language, not because it was forced by one contract, but because the incentives aligned around it. And once a common language exists, switching costs become brutal. Switching the language is not free. You do not just decide to speak a new language at the airport and assume the entire control tower understands you. You do not just move your factory to a new electrical standard and assume every tool plugs in. You do not just rewire global commodity finance without paying a massive friction tax. That friction tax is the real defense of the dollar system, not a treaty. Now, here is the part that will make your brain itch because it sounds boring, but it is the core of everything. The dollar stayed dominant because it is convenient. Convenient is not soft. Convenient is power. Convenient is the reason a payment network wins. Convenient is the reason the biggest marketplace attracts more sellers and more buyers until it becomes the default. Convenient is the reason the deepest bond market becomes the place surpluses go when the world needs parking. Convenient is the reason the dollar gets used even by people who do not politically like the United States. Now, before I tell you what would actually break the petrodollar machine, I want you to notice something. Every time the petrodollar death headline goes viral, it has the same emotional structure. It tells you the dollar is finished. It tells you a new currency is rising. It tells you oil will switch. And then it implies, without saying it out loud, that you should panic buy something, gold, Bitcoin, a random foreign currency, a small commodity stock, a basket of doom trades. And the reason it works is because people feel like they missed the secret. So let me give you the secret you actually need. If you want to know whether the petrodollar is weakening, you do not watch speeches. You watch behavior. You watch what exporters do with the money after the sale, because that is where the system lives. If an exporter sells oil and then parks proceeds in dollar assets, uses dollar collateral hedges in dollar markets, borrows in dollar markets, and settles the rest of its global supply chain in dollars, the petrodollar machine is still alive. If exporters start consistently doing the opposite, not once, not as a headline, but as routine, that is when the machine is changing. Now, keep that in your mind because it leads to the next mystery. If the petrodollar is not a treaty, what is the real advantage that keeps it in place? Here it is. Oil is not just a commodity. Oil is a financial product. It is financed. It is hedged. It is stored. It is shipped. It is insured. It is traded through benchmarks. And the biggest benchmarks in hedging ecosystems are still dollar-centered. That matters for companies, ExxonMobil, Chevron, Shell, BP, and the big integrated producers operate in a world where dollar financing and dollar settlements simplify global operations. The giant commodity trading houses like Vitol, Trafigura, Glencore, and Mercuria live on liquidity hedging and access to the deepest pools of credit and derivatives. The exchanges and infrastructure firms like CME Group and Intercontinental Exchange benefit from the fact that global commodities are largely priced and hedged through their ecosystems, which are heavily dollar-based. The big global banks, especially the ones with deep commodity and FX operations like JP Morgan, Citi, and Goldman Sachs, benefit from being the toll booths on the highway. When trade clears through dollar rails, they process volume, provide hedges, provide credit, and clip spreads. And here is the part people do not like to admit. Even payment giants like Visa and MasterCard are indirect beneficiaries of a dollar-centric consumer and cross-border environment, not because they control oil, but because dollar dominance supports a global network of dollar-linked spending, settlement, and financial behavior. Now, flip the picture. If settlement fragments, if invoicing becomes multi-currency across corridors, if hedging becomes more regional, if capital pools become more politically segmented, the winners shift. Local and regional banks that specialize in specific corridors can gain share. Non-dollar payment infrastructure grows where it is politically supported. Energy trading becomes more complex, and complexity creates opportunities for sophisticated intermediaries while raising costs for everyone else. You see more FX hedging demand, more basis risk, more operational friction. That can be good for some trading desks and bad for corporate treasurers who just wanted simple planning. So here is your second ledger beat. You've saved the comfort of one global standard, but you paid for it with concentration risk. If the standard ever weakens, you do not get a clean switch. You get fragmentation, and fragmentation is expansive. It is like replacing one highway with a maze of smaller roads, each with its own toll, its own rules, its own speed traps. Now, this is where I am going to make you a promise. In a moment, I am going to tell you the small set of signals that actually matter, the ones that show whether the petrodollar machine is leaking. But to understand those signals, you need one more piece of plumbing. You need to understand the difference between pricing currency and funding currency, because this is where people get tricked. A country can price oil in a different currency for political optics, but the deeper power is funding. Funding is which currency you borrow in, which currency you hold reserves in, which currency your banks clear in, which currency your contracts and collateral are built around. Pricing is the label on the box. Funding is the warehouse. And warehouses do not move because of a tweet. They move because the cost of staying becomes higher than the cost of leaving. So what raises the cost of staying? Sanctions risk, payment rail risk, asset seizure risk, political risk, and the need for When countries feel that dollar rails are a vulnerability, they look for alternatives. Not because alternatives are superior, but because dependence is dangerous. That is why the Petrodollar debate is really a debate about power and enforcement, not just oil. Now, ask yourself a simple question. If you were a country that feared losing access to dollar rails, would you keep all your wealth inside the rails that can be turned off? Or would you try to build a second door? That second door is what people call But here is the twist. Building a second door does not mean you stop using the first door. It means you want redundancy. And redundancy is how systems change, not with a dramatic switch, with parallel pathways that slowly become normal. Now, you can probably feel where this is going. You want to know whether the petrodollar is dead. The real question is whether the world is building enough parallel pathways that the dollar stops being the unavoidable center of gravity. And that is measurable, not perfectly, but measurably. Now, let me pull you back into the human side, because this is where the money decisions come in. If you believed that the petrodollar was a treaty, you probably believed the end would be sudden. A date on a calendar, a cliff, if you understand it, is a network effect machine. You should expect a different kind of change. Slow, uneven, corridor by corridor, industry by industry. More like language evolution than a revolution. And that changes what you do as an investor and as a citizen. You do not bet your entire life on a single collapse narrative. You build optionality, you reduce single point of failure risks, you stop confusing doom with strategy. You hold assets that can survive multiple regimes. You avoid being forced, because the people who get destroyed in currency regime shifts are not the people who guess the future wrong. They are the people who built a plan that only works in one future. So the practical play is not to scream the dollar is finished. The practical play is to watch the leaks in position with resilience. That means if you are a stock investor, you pay attention to who benefits from dollar rails staying dominant and who benefits from fragmentation. If dollar dominance stays strong, the big dollar-centric market infrastructure tends to remain advantaged. Global banks with deep dollar plumbing keep their role, and U.S. assets keep attracting global pairing behavior. If fragmentation accelerates, you can see higher demand for hedging, higher demand for energy and commodity intermediaries, and more emphasis on defense and cybersecurity because economic fragmentation is rarely peaceful. Companies tied to infrastructure, energy, security, and supply chain resilience often become more strategically important in fragmented worlds. That can include defense primes like Lockheed Martin, Northrop Grumman, and are not because war is inevitable, but because governments spend more on security when the world feels less integrated. It can include energy infrastructure and LNG players when regions prioritize secure supply chains. It can include certain commodity producers when countries want friendly supply, and it can also increase the value of companies that sell the tools of risk management, the exchanges, the clearinghouses, the brokers, the market makers. Because fragmentation increases the need to hedge. But again, None of this is a command to buy anything. It is a map of incentives. Now, you are ready for the leak map, and this is where the petrodollar myth turns into a real test. In the next chunk, I will show you the signals that matter, the kind that cannot be faked by a headline. You will see how to tell the difference between symbolic de-dollarization and structural de-dollarization. You will see what to watch in oil trade behavior, what to watch in reserve behavior, what to watch in funding behavior, and what to watch in market plumbing that reveals whether the dollar is losing the one advantage that actually matters. Because if you understand that advantage, you stop chasing doom trades. You stop being emotionally rented by viral myths, and you start making decisions like someone who understands how power actually moves through money. If this episode is already reshaping how you think, hit like, subscribe, and share it with a friend who keeps saying the petrodollar treaty expired because the fastest way to calm a room is to replace a myth with a machine. Now, let us open the machine. Forget the myth for a moment and picture a simple system you have lived inside without noticing. You go to a busy city and you choose where to eat. Not based on the best menu in theory, but based on the place that can seat you, serve you fast, take your payment, and not poison you. The busiest restaurant gets busier because it can handle volume. The quieter restaurant might be great, but if it cannot process the rush, it does not become the default. The dollar became that busiest restaurant for global trade and especially for oil, not because every customer loves the chef, but because the kitchen is huge. The supply chain is reliable, the payment system is mature, and the security outside the door feels predictable. So when someone says the petrodollar is dying, the question is not, did somebody order one meal in another currency? The question is, did the world build a second restaurant that can handle the same rush? And that is where the machine lives, in capacity and trust, not in headlines. Now here's the mystery I promised you. If this system is weakening, the first visible crack will not be oil being sold in a different currency. It will be what happens after the sale, where the money sleeps. Because oil revenue does not just get collected in a mire, it gets recycled. It gets parked, it gets invested, it gets collateralized, it gets lent. It gets turned into political leverage and financial stability. That recycling behavior is the hidden heartbeat of the If you want to find the heartbeat, you watch the parking lot. For decades, a big part of the world parked surplus dollars in the deepest parking garage on earth, the US Treasury market and dollar assets more broadly. Not because it was morally pure, but because it was large enough to absorb surpluses and liquid enough to be sold in emergencies. That is the petrodollar machine at work. Oil flows out, dollars flow in, dollars flow back into dollar assets. And the US gets a quiet benefit that most people never feel directly, but everyone lives inside. Global demand for dollar assets helps keep borrowing costs lower than they otherwise would be, and it helps keep the dollar liquid in a way that attracts more use. You did that. You saved in dollars, you held cash. You bought bonds in your retirement account, you kept your emergency money in a bank. You gained convenience and stability, but you also paid a hidden fee. You paid with concentration risk. Your life became more dependent on one system staying credible. So the real question is not, is the petrodollar dead? The real question is, are the parking habits changing? And they are changing, but not like a movie scene, more like a slow rerouting of traffic. Some flows are experimenting with other rails. Some countries are building redundancy. Some are trying to reduce exposure to sanctions risk. Some are trying to settle trade in ways that cannot be easily interrupted. That is not the same thing as the dollar collapsing. It is the same thing as the world adding parallel pipes. And parallel pipes matter because they change bargaining power even if the main pipe remains the largest. Now let me give you the leak map. The signals that tell you whether this is symbolic or structural. Watch the invoicing language, but do not worship it. If you hear an oil sale was invoiced in yuan, in euros, in rupees, treat it like a headline that points at a deeper question. Did the exporter keep that currency? Or did they immediately swap it back into dollars behind the scenes? Because if you sell oil in a different currency and then immediately convert it into dollars to hedge, to park, to pay suppliers, you did not change the machine. You added a cosmetic layer. The deeper leak is when exporters begin holding and using non-dollar currency at scale over time, not as a stunt, but as routine treasury behavior. Now watch the hedging ecosystem. Oil is not just sold, it is hedged. If the deepest hedging pools remain dollar-centered, the dollar remains the gravitational center, even if some invoices change. So the more meaningful shift is when you see hedging liquidity grow in non-dollar oil contracts in a way that attracts real volume, real market makers, real clearing depth, real confidence. That does not happen because someone gives a speech. It happens when enough participants decide the non-dollar pool is safe to swim in. Now watch the banking rails. A currency is not powerful only because people like it. It is powerful because it can move when it needs to move. If more trade starts clearing through alternative messaging and settlement rails, if more corridors build a habit of non-dollar settlement, that is a real leak. Not because the dollar disappears, but because the dollar becomes less unavoidable. That is what de-dollarization really is in practice. It is not a throne being toppled. It is a toll road getting bypassed more often. Now, watch reserve behavior. When countries change what they hold as reserves, it is not a tweet. It is a policy decision. It reflects trust, risk management, and political calculus. Reserve shifts are slow, but that is why they matter. They are the oil tanker turning, not the speedboat. If the reserve mix slowly diversifies away from dollars, it is a leak. Not necessarily a collapse, but a leak. Now watch the currency peg story in the Gulf. This is where the petrodollar myth turns into the petrodollar reality. A lot of oil exporters in the Gulf have currencies that are linked to the dollar through pegs or type bands. That means their monetary policy is partially imported from the United States. When the dollar strengthens and US rates rise, the Gulf often has to follow, even if their domestic economy would prefer something else. That peg is a stability tool, but it is also a leash. So the question is not only what currency oil is priced in, the question is whether the Gulf can and wants to keep dollar pegs over the long run. Because the peg is one of the strongest anchors tying their financial system to the dollar ecosystem. If pegs hold, the machine holds stronger. If pegs wobble, the machine is under strain. Now watch sanctions behavior. This is the real the dollar is not only a currency, it is a network. And networks can be weaponized. When countries see the network as a vulnerability, they build alternatives. So when enforcement expands, redundancy expands, that does not guarantee the dollar dies. It guarantees the world becomes more fragmented. And that fragmentation is the environment you should prepare for, because fragmentation changes everything, even if the dollar remains the largest node. It increases FX volatility, it increases hedging costs, it increases geopolitical risk premiums. It increases the value of control over commodities, shipping lanes, insurance, and infrastructure. It also increases the value of competence, because sloppy balance sheets get punished harder when the world is less stable. Now let us turn this into what you actually do with your money and your attention without panic. The biggest trap is going all in on the collapse narrative. Collapse narratives feel like certainty, but they are usually just stories that make you do one thing: concentrate, risk. You sell productive assets for a bunker fantasy. You abandon diversification. You chase a single hedge as if it is a lifeboat. You leverage into a trade that assumes one outcome. And then you get destroyed, not because your thesis was morally wrong, but because the world changed slower than your margin account could survive. The smarter move is to build resilience. Resilience looks boring on purpose. It means you own quality assets that can tolerate volatility. It means you avoid leverage that can force you out. It means you hold some liquidity so you can act when others are forced. It means you diversify your exposure so your life is not dependent on one currency regime, one headline, one corridor, one election, one shock. In a world where settlement fragments, the winners are often the people who can absorb friction while others choke on it. Now let us talk about the stock side, because you asked for companies and you deserve a map that is more than ideology. Start with the oil majors: ExxonMobil, Chevron, Shell, BP, Total Energy. These companies sell energy into a world that is still heavily dollar-linked, but they also operate globally, hedge globally, and finance globally. If the dollar remains dominant, their operational simplicity remains higher. Their hedging remains in the deepest pools, and their cost of doing business across borders remains more standardized. If settlement fragments, these majors do not automatically lose. In many cases, complexity benefits the largest players because they have the treasury sophistication to manage the relationships to clear trades, and the scale to negotiate terms. Fragmentation can raise friction for smaller players, while the giants adapt and even gain share. Now look at the commodity traders: Vitol, Trafigura, Glencore, Mercuria. These are the intermediaries that thrive on flows, spreads, and complexity. When the world becomes more fragmented, you can get more basis risk, more corridor risk, more financing complexity, more hedging demand. That can increase the value of sophisticated trading and risk management. It also increases the risk of accidents, which means the best capitalized firms with strong controls tend to survive and consolidate. Now look at the market infrastructure. CME Group and Intercontinental Exchange. When hedging demand rises, volumes rise. When volatility rises, volumes often rise. When new contracts emerge and liquidity wars happen, exchanges compete for the new flow. If the world stays dollar-centered, the existing dollar benchmarks remain dominant. If the world fragments, you can see a period where new products and new clearing arrangements become important. And the infrastructure layer becomes a battlefield, not a footnote. Now look at global banks. JP Morgan Citi, Goldman Sachs, and on the international side, HSBC and Standard Chartered. When dollar rails dominate, the biggest dollar plumbing banks collect tolls. They provide FXs, commodities financing, hedging, clearing, custody, and credit. If fragmentation grows, banks that can operate in multiple corridors and manage compliance complexity can gain, but the risk environment also rises. That means bank balance sheet quality and risk controls matter more. In unstable worlds, the market stops rewarding optimism and starts rewarding resilience. Now look at defense and security, Lockheed Martin, Northrop Grumman RTX. This is not a claim that war is inevitable. It is a claim that in a more fragmented world, governments spend more to protect supply chains, secure energy routes, defend infrastructure, and maintain deterrence. Energy security becomes national security faster when global trust declines. Now look at energy infrastructure and LNG. In a more fragmented world, regions prefer secure supply from friendly corridors. That increases the strategic value of export terminals, shipping capacity, and reliable infrastructure. The names vary by region, but the concept is consistent. Infrastructure that turns energy into deliverable security gets valued differently when trust is scarce. Now look at the dollar itself as an asset behavior. Here's the paradox that destroys simplistic petrodollar collapse stories. In periods of global stress, the dollar can strengthen even if the long-term narrative says it should weaken. Because when the world panics, it runs to the deepest pool. So you can live in a world where de-dollarization is slowly advancing in some corridors while the dollar still spikes during crises. That is not a contradiction. It is a network effect behaving exactly as designed. So if your plan assumes the dollar only goes down from here, you are building a plan that ignores the stress reflex of the system. Now let me give you the prize you came for, the direct answer. What would actually have to happen for the petrodollar machine to break in a meaningful way? Not a headline, not a ceremony, not a symbolic oil invoice. You would need a sustained shift in the full stack. You would need large producers routinely invoicing in non-dollars and also routinely holding those proceeds in non-dollar assets, and also routinely hedging in non-dollar markets, and also routinely financing supply chains in non-dollar credit ecosystems, and also routinely clearing through non-dollar rails. In other words, you would need the second restaurant to handle the rush, not once, but every day for years. And you would need enough trust in that system that people accept lower convenience in exchange for lower political vulnerability. That is a high bar, which is why the more realistic story is not petrodollar death. It is petrodollar death. Less monopoly, more competition. More parallel pipes, less single point of failure. That dilution still matters. It changes costs. It changes volatility. It changes who has leverage. It changes how sanctions work. It changes how crises propagate. It changes what assets behave like safe harbors. And it changes what kind of companies thrive. Now here is the final ledger beat, because it ties everything together. You saved convenience by living in a world with one dominant settlement language. You paid for it with fragility, because dominance creates dependence. The world is now trying to buy back optionality. Optionality is expensive. It shows up as friction, as redundancy, as parallel rails, as higher hedging costs, as more complex trade finance, as more geopolitical premiums in places you used to ignore. That is the real story. Not a treaty that expired, a machine that is being asked to share power. Now, what do other people do in this environment? The people who actually run treasuries and build real plans, they do not bet everything on one narrative. They build layered protection. They match assets to liabilities. They keep liquidity. They diversify funding sources. They avoid being cornered. They keep multiple banking relationships. They hedge the risks that can ruin them and accept the risks that cannot. They do not try to be heroes. They try to stay solvent and flexible. You can do a smaller version of the same thing in your own life. Keep your plan simple enough to execute and robust enough to survive. Avoid leverage that can force you out. Favor quality over hype. Assume volatility returns. Assume headlines will lie by omission. Assume the transition is uneven, and keep your eyes on the dials that cannot be faked by a viral video. Where did the proceeds park? Where did the hedges live? Where did the rails clear? Where did the reserves move? Where do the pegs strain? Where does the cost of insurance and shipping finance rise when the world gets less trusting? Now let us end where we started, with a sentence that keeps going viral, but this time you will hear it differently. The petrodollar is dying again. The truth is, the petrodollar is not a switch that dies. It is a network effect that can weaken at the margins while still dominating the center. That is why it will feel like it is dying every time a new corridor experiments with a new settlement path. And that is why people will keep getting manipulated by the myth if they do not learn the machine. If this gave you clarity, hit like, subscribe, and share this with a friend who thinks the petrodollar was a secret treaty that expired, because the fastest way to stop being fooled is to stop chasing the story and start watching the plumbing. And tell me in the comments what you think breaks first in a more fragmented settlement world. Do you think the stress shows up in oil pricing, in shipping and insurance, in emerging market currencies, or in US borrowing costs? Because once you know where the stress shows first, you stop being surprised. You stop being forced, and you start making decisions from a place of understanding instead of fear.